I think I would suggest partnering with a property management company to help you scale, and then maybe you bring it in-house later. And that's what we've done. So maybe that's why I'm suggesting that. But that was a huge help to us in how we were able to go from a duplex to a 16 unit.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is Lee Yoder of Threefold Real Estate Investing. He's an investor that's based in Ohio. He's got a lot of experience in small to mid-sized multifamily. He's also done a couple of large multifamily transactions as well. But he's somebody that approaches the business in a very similar way that I do, which is he's very operationally minded. He's somebody who grew relatively quickly, but also organically in that he went from doing small deals to kind of small multifamily pretty quick, went from doing a house flip to a duplex. He did a 16, then he did a 10, then he did an 8. And then he jumped up to doing larger deals after that. But somebody that has grown pretty organically, somebody that is very focused on operations. And he's just a great guy. He's really a great conversation, great guy to listen to, somebody who approaches the business in a way that I think everyone who's in this game should approach it. So stick around and listen to this episode, talk about Lee's story, talk about how he was able to go from 2 units to 16 pretty quickly and how he got comfortable with that, how it's evolved over the years in terms of how he raises capital. I should say how his business has evolved over the years. And we also talk about why he decided to start his own management company. And I think that's a really interesting conversation for the multifamily operators that are listening, because he did so before he was really at any level of scale. Most multifamily investors that you hear on podcasts, when they talk about bringing management in-house, usually they're at like 500 units, 700 units, 1,000 units, and they bring it in-house by hiring a team and by actually starting with some scale. Lee's doing it with a smaller portfolio right now. He's since sold a lot of properties that he's bought over the years. And he's doing it right now with 60 units and change, which presents all kinds of different challenges. And it's interesting to hear him talk about that. So I highly recommend you listen to the end of this episode so you can learn a little bit more about that process from somebody who's actually doing it. Now, if you haven't already, please leave the show a rating and review, as it helps it get noticed by more folks. And again, if you haven't checked out the off-market deals course, highly recommend you check it out. We're now donating 5% of gross sales, so not net income or profit, but gross sales to Aligned Giving, which is our charitable cause that supports organizations combating the homelessness crisis. And we're really, really proud of that. So every course sale goes to combating homelessness crisis, supporting the homeless. And I highly recommend that you check the course out just on its merit alone, as it's a program that has helped hundreds of investors build robust pipelines of off-market multifamily deals. So go check that out if you haven't already. But let's get to Lee Yoder. Welcome back to the Multifamily Wealth Podcast. Joining me for a second time is I can't remember the last time you were on, Lee. It was probably over a year ago or so. But
yeah, definitely over a year ago.
Maybe a couple of years ago. I'd have to go back and look. But anyways, joining me for the second time is Lee Yoder, who is a real estate investor based in Ohio. He's a Buckeyes fan. He's a Bengals fan. He's in multifamily. He's also a podcast host. We got a lot of the same things going on, and kind of a similar business trajectory as well. So, in general, Lee, why don't we start with your story? Because I think it's been a while since the first time you were on, so people could probably use a refresh. But tell us about how you got into real estate, what your business looks like now, and what you've been up to.
Yeah, Axel, pleasure to be back on the show, man. Really enjoy watching what you and your team are doing. And I think we're on a similar trajectory, although I would say yours seems like it's a little bit steeper and a little bit further ahead. So I'm happy to be chasing along right behind you, hopefully. I was a physical therapist. So went to school for a really long time to make us get our doctorate now. So I had a doctorate in physical therapy, but I was out doing that for a couple of years. Actually got into doing home health physical therapy, and it was a great job for the family. I had a lot of flexibility. So my wife really loved it. We were starting our family at the time, but I was just really bored. It just was not the job for me. Quickly, I'm like, man, this is not what God created me to do. So I'm kind of looking for something else. Well, the company I was with brought me in-house. I became the clinical director. So now I'm doing more like business. I was doing no physical therapy. So 2 years out of a 7-year degree, and I'm, just in the office, but like doing more business and operations type stuff. And I was loving it. So now I'm like, this is what I was made to do. It was a startup company. So it had like the entrepreneurial feel, a lot of young people, and I was just given a lot of freedom, a lot to kind of like build out my division. that I was, working in for that company. So really enjoying it. But now I'm kind of on the opposite end of the spectrum where I have like no flexibility. And it's, this was pre-COVID. So it was like in the office as much as possible. And everybody's working really hard to grow this company. There's tons of opportunity, but it's like, be in the office as much as you can. So now my family's kind of suffering. And now we have 2 young kids. And my wife is home with them, which gives us flexibility, but also like she's ready for me to be home at some point. Right. Cause maybe you've heard this from your wife, like, hey, anytime you work overtime, I'm working overtime, just remember that. So it just like after a little while of that, it felt like, man, this isn't really exactly what I feel like God has called our family to either. And I was starting to really kind of feel like the entrepreneurial bug a little bit and just wonder what else is out there. What could I maybe go do? And so I started just kind of reading some business books, ended up reading Rich Dad, Poor Dad. Kind of went down that rabbit hole and real estate spoke to me pretty quick. My dad's in construction. I've done some construction myself. So even kind of that side of it, but I'm total math guy, always have been, didn't know what I was going to do with that. Now I use math all the time and love it. So Axel, I decided to leave the corporate job, go back to home health physical therapy, where again, easy job, tons of flexibility, honestly, kind of boring for me. And I'm like, but I'm going to do real estate on the side, like pick up real estate as a side hustle. So left that corporate job at the end of 2016, took a pretty big pay cut, but knew this was a long-term play and I'm going to do real estate on the side. And so it wasn't until 2017 that I did my first flip. 2018, we did a duplex. 2019, we got a 16 unit, an 8 unit, and a 10 unit. Took a whole year to turn those around. Sold all 3 of those at the end of 2020 and the beginning of 2021. I quit as a physical therapist at the end of 2020, went all in, by selling those 3. I mean, we just got lucky, with the timing, right? Bought them at the end of 2019, market went straight up, kind of doubled the value of all of them. I mean, we heavy value add, so we did do a lot of work, but I mean, we profited way more than we should have,
It's excellent timing. That's about as good as the timing. Yeah,
absolutely. So, but that was awesome. Like great for me. I mean, of course, go back. I wish I could have bought a lot more, but hey, it allowed me to jump into it full time because we just went the route. Instead of replacing my income with our cash flow, which was what I originally told my wife, we just sold and stuck all that in our savings account and was like, here's our runway. Here's our cushion. I'm going to go try this full time. This will support us for 3 or 4 years. We'll just bleed our savings if I can't do anything. And then I'll go back to being a physical therapist. I mean, my wife's an RN. Again, she stays home with the kids, but she could go back to being an RN if we had to. So it was like, let's try this. So in 2021, I'm full-time. We syndicated 3 properties that year, 1 the next year, just 1 in 2022. We got 283 units. You and I were talking before, it got really tough to find good deals these past 12 months. So we didn't find anything. We finally did a 64 unit just recently, but we're selling a couple. So that's where we're at today.
Yeah, I mean, that's a hell of a story. It's like, it seems similar to I guess mine and probably a lot of real estate investor story. It's almost like an EKG. It's just straight up and, kind of down and then to the side and then back up, it's just, which is, I guess the name of the game that we're in. Sure. But, I'm going to highlight maybe a jump you made early, in this 2018, 2019 timeframe. And then we could talk about, why you've, transitioned, why you kind of sat out for a year, some of the deals you're into now. But you mentioned, and tell me if I got the sequence right. You went from a duplex to a 16. And then you also bought a 10 and an 8, kind of around that same time frame. But most people have trouble going from 2 to 16, right? Especially if they don't own like a handful of duplexes or smaller properties. But like flip duplex, then a 16. I mean, that's pretty aggressive in terms of just, trusting your gut, knowing what you're doing, feeling comfortable to get into a deal like that. What was your thought process at the time? And was there anything that you did at that time to feel comfortable with making that kind of a leap?
Yeah. Great questions. And yeah, I mean, buying that 16 unit, like today, feels like it's not a big deal. Back then, I mean, I was really intimidated. My wife was terrified. So it was a big deal. Yeah, it's a huge jump going from 2 to 16. So my mindset was, you get the duplex. A lot of people go through this, Axel. We got the duplex, very successful. We have it rented out. We're holding on to it. We didn't end up holding it even a full year, but while we had it, it's like, okay, here's the proof of concept. We'd already flipped the house, and right away my wife was like, that wasn't what you told me. She's like, there was nothing passive about that. It's like, so luckily, I've got a good, strong wife. And so it only took us one flip to realize flipping's not investing. It's a fine way to get in. You can make money at it. I don't want to, crap on it, but it's not investing. It's not, there's nothing passive about it. So we jumped duplex. We have it rented. We're like, okay, this is legit. We had renovated both sides. So it was going to be pretty passive. As long as we held that, kept it full, we're going to cash flow every month. And meanwhile, we're paying off the debt, right? So great. So this is awesome. But I don't know what it was, Axel, to remember, but I mean, maybe we're making a couple, I don't know, maybe $4,000 a year, let's say. Well, I want to make like 80 a year just to replace my income, or like, just support our basic expenses are probably 80 a year. So that's 20 duplexes at $4,000 a year. So I didn't want to own 20 duplexes. I didn't want to find 20 different duplexes. I didn't want to manage, because we're managing this one ourselves. I didn't want to manage 20 different duplexes. So I'm just listening to podcasts, not yours at the time, but very similar to yours, Axel. And like, just hearing guys like, they went bigger. And here's why: you can get professional property management. The scale, you don't have to do as many deals. You can make more cash flow off of one purchase. And so all that stuff really made sense to me. And I'm, talking to people locally as well. So that was the impetus behind it. And I, at the time, I didn't want to manage my own properties. And I would say, we're now bringing property management in-house. We can talk about that later. But at that time, Axel, using third-party property management was probably the biggest tool that I had. Now, I had a local mentor that really helped me as well. I joined the local RIA, the Real Estate Investment Association of Cincinnati, had a mentor in there. He was teaching apartment focus group. He taught me to underwrite and taught me these different things, kind of held my hand through that 16 units. So that was a huge help. But what was overwhelming to me is considering managing those 16 units and getting 16 people to pay rent and answering maintenance calls for 16 people. That seemed absolutely overwhelming. This duplex was right in my hometown. 16 unit was like 25 minutes away. So that was overwhelming. Once I decided that this property management company who managed 1,000 units in that city was going to manage this little 16 unit, I'm like, well, that's no big deal for them. That's going to be easy. And when I talked to them, it felt like that to them. So all of a sudden that was like, well, shoot, all I got to do is put this deal together and be the asset manager. I don't have to manage those 16 residents. That's what allowed me to get over that hurdle. So while I do think I'm starting to think like bringing property management in-house is the right choice for us, I don't know. You said, it's a huge jump if you don't own a few duplexes. So if you want to like pick up 4, 5, 6 duplexes and you're managing them all to yourself, then you're probably ready to go and get a 16-unit manager yourself. If you want to jump quicker, I think I would suggest partnering with a property management company to help you scale, and then maybe you bring it in-house later. And that's what we've done. So maybe that's why I'm suggesting that. But that was a huge help to us in how we were able to go from a duplex to a 16-unit.
Yeah, for sure. And I think a lot of folks probably have the same reservations, where they're looking at the sheer volume of work required to, especially if you have a job, right? Especially if you have something else that is calling for your time, and you're like, all right, I did this duplex. That was kind of easy. We did some carpeting and we put it, but now it's like 16 apartments. I'm just worried about how many calls I'm going to get, or what if I have a few units that turn over at the same time? Everything, you're thinking about how much time you have to invest. But then if it just becomes a math problem, which is all it is, if you have a property management company, you're just doing some math, and then you got to spend an hour a week holding them accountable. Yeah, it becomes a lot less intimidating. And I agree with, I certainly agree with your statement about go take your properties to a management company like in the beginning. And then if you want to go and take it over afterwards, when you have a little bit of scale, you have a number of doors and you feel really comfortable with that part of the process, then do it. And most people do it the other way, right? Where they self-manage for a very long time and then they hand over a massive portfolio to a third-party management company. But inverting it is smart because you don't know what you don't know in the beginning, and you're so likely to get screwed or just taken advantage of, or do something wrong, or, rent it at the wrong price, or rent to the wrong person, or do any of these things that, in 16 units, right? If your portfolio is not that large, can have a pretty serious effect on your ability to do more deals if you start screwing up and compounding your errors. So
I agree.
I think that's a great piece of advice. Now, let's talk about, so you did the 16, the 10 and 8, you kind of turned them all around, you sold them, you did really well. And then you mentioned you took some time off. So I want to talk about that a little bit, because I think if you're anything like me, it's like you want to do deals, you want to grow the business, you want to grow, you want to keep going and going, but it takes a lot of discipline to take a step back if something isn't working for you. So maybe talk about that time period in which you basically took a step back, and it sounds like you really evaluated what you like to do.
Yeah. Well, there was kind of two gaps. So we purchased those 3 small multis at the end, fall and the winter of 2019. And then it took me a whole year to turn those around. And And then, so it was like a year and a half. So I was really just working in the business, like people say, you're not supposed to do if you want to keep growing the business. But I was learning, man, just like you said, I was learning to be a GC. I was learning what it looks like to turn an apartment building around. I mean, they're small. So I just learned for that entire year. And I was always looking for deals. Even back then, it was, tough to find really good deals. Multifamily has been competitive for a long time. It's had some different flavors, but it's been very competitive for like 5, 6, 8 years straight. So
since both of us have been in it, honestly.
Yeah, right. Exactly. It's been very competitive. So it was hard to find deals. I was just all in on those three. And so that was what that was learning. And then, as I started selling those, I was ready to bring on more investors. And then, we had a good run where we purchased 4 in like, a year and a half or something. And then we took a year off where I was really trying to find deals, but, man, we just try to stick to our underwriting, and we're really big on cash flow. And when interest rates go up, it really hurts your cash flow. And so you might be able to get a better deal. And so I'll look at a deal and say, man, back in 2021, beginning of 2022, before the rates went up, maybe I would have had to pay 8 or 10 million for this property. And today I can buy it for 8 or 9. But it doesn't cash flow. And I just can't do that. So it may feel like you're getting a deal, but for me, it's got to cash flow. It's got to cash flow well. I want to see a lot of cash flow because that cash flow is our margin. I don't care that much if I tell the investors we're going to pay, 8 or 10% and we only hit 5 or 6 or something. But that's the margin I want to see. So that's the reason for the break over the past year. Just couldn't find good cash flow. And we're sticklers for that.
Yeah, and you were looking at, and this is in Ohio, right? You're looking
for Southwest strictly. Ohio.
Okay, gotcha.
Yep.
Because I'm just personally interested, like what was obviously interest rates going up starts to eat into everybody's margin, right? And it's hard to hit those cash on cash returns you want to see. And, there's less of a spread between rates and cap rates and all of that. Yep. But what were you seeing maybe in like the 2019, 2020, maybe 2021, that kind of time frame in terms of like what you were either achieving in cash flow or seeking in regards to cash flow and actually doing deals versus what it looks like now? I mean, just to give some context to the listeners.
Yeah, good question. It was very different, Axel, because back then it was a joint venture. So I was just partnering with one family member, one close friend. And so we would just be like 50-50 partners. And man, I think it's a great way to get started. If you can find 1 or 2 money partners, you find the deal, you do the work, they're your money partners, and you give them half and you keep half. That's kind of how I did it. It's a great way to do it. So back then, Axel was like, I was seeking, honestly, like I wanted them to make 10% per year. Was kind of what was in my mind back then. And then I wanted there to be a bunch of upside. And that's kind of how I thought about it. And they were, it was my in-laws, it was my parents, it was my best buddy from church. Like they trusted in me and they didn't need the money right then. So some of them, it was like, oh, actually, this is more of a flip than I thought. And we're not going to cash flow, but we're going to, make more on the back end. And, we ended up selling all those and did awesome. But back then it was like, I kind of wanted my partner to make 10%. And then I was kind of looking at like, well, what's that for me? So if I raised $100,000, I want them to make 10 grand a year. And so then I would get 10 grand because we're 50-50. And so I needed 20,000, of good cash flow per year off that project. And I'd look at the project and I was like, is it worth it to me to make $10,000 a year? So I think $10,000 a year for them, it's going to be great. 10% return is great. I think they're going to be very happy with that. For me, I'm doing all the work and like, is this going to be worth $10,000 a year? And so I would pass on some. There were some 10 units and 12 units at the time. And I was like, and it wasn't 10, it was maybe like 5 or 7. I'm like, man, all the work, I don't think $5 grand a year is worth it to do the transaction. So I passed on a lot back then, but that's how I was looking at it. It's like, I wanted them to get a 10% return, but then I'd look at myself too and say, is that worth it for me to do this deal and do all the work? And you got to consider the back end too, right? But that's kind of how I was looking at back then. And then today, Axel, it's shifted, but originally my goal was to get our investors 8% per year. We would do an 8% preferred return. So I wanted to see 8% plus some. The last deal we did a 6% preferred return because again, the bank is just taking so much more of the money that it's that's where the other part of their 8% went. They took it down to 6. I think we're doing just as good of a deal. It's just the bank is taking a lot more of the money. So, but yeah, now we're doing preferred returns. I didn't do a preferred return back then. Like I said, just a 50-50 split. Now we do a preferred return, which means investors get paid first and then we split after that. So that's a little bit how it's different.
Cool. No, that makes total sense. Yeah. And Yeah, it's not easy to find deals that hit those numbers, even in, Ohio being more of a cash flow market than
right.
Where other folks are, whether it's, a major city or just the Southeast, Southwest, where pricing has gone nuts and cap rates are low and, all of that.
Yep.
It doesn't matter where you're at. It's challenging. So have you, because obviously you transition from doing, smaller deals to larger deals, transition from, working with a partner or two, as you just described, to maybe working with more investors. I'm making that assumption, and correct me if I'm wrong,
you're right,
in terms of raising more capital from more, individuals.
Yep.
What has been the process like to maybe either recalibrate investor expectations or to kind of communicate to them that, hey, we're kind of reaching a new normal here in terms of what a deal looks like, in terms of what you should expect with returns? Like, have you been having those conversations, and what's that been like?
Yeah, we definitely have tried to do that. We do a monthly newsletter where we're trying, I know you do too, Axel. We're just trying to keep people educated. So all during this past, 12 months where we didn't purchase anything for 12 months. I mean, I'm in my newsletter, I'm trying to, update people on what I'm seeing and why we're not buying anything and what interest rates are doing and what that's doing to, cash flow and things like that, and why it's hard and the demand. But at the same time, why I am long-term, any time horizon past 1 year, 2 years. I'm very bullish on multifamily. So also, projecting that to our investors, like, hey, we're in this for the long run. I think multifamily is the way to go. I'm not going anywhere, but this is why we're not purchasing. It's a difficult time, things like that. So yeah, all along trying to educate. But I'll say a lot of our investors, Axel, their expectations have been adjusted by the market, right? Because if I remember back. We had a couple investors that said something along the lines of this would have been like late 2021. They were like, well, I'm making 16% in the stock market, so why would I invest with you guys? And, my answer was like, well, if you think you're going to continue making 16% in the stock market every year, then I would just do that. We're not going to do that. Right. So they didn't, 2022 was down, 12 to 15%, depending on, where you had your money. So expectations got adjusted from that, right? So now a lot of people are like, oh, so like we can lose money in the stock market, and there's a reason that we could maybe go to a safer investment, something tangible, something like real estate, where there's multiple benefits, and we've got cash flow and we've got tax advantages and we're paying down the debt and things like that. So some of the expectations have been adjusted by the market. But yeah, we've tried to do some education on this is why. And then, there's so many benefits to multifamily or just real estate investing in general. Yes, everybody loves that cash flow. And I do too. And I talk about it a lot, but there's other benefits. And I think people see those. So even though the cash flow went down, instead of you invest $100,000, instead of making $8,000, you're going to make $6,000, that hurts a little bit, but it's like, that's $2,000 a year. Okay, what's on the back end and what are some of the tax advantages and things like that. I think people see those as well.
Yeah, no, we're saying the same thing, and it's cash flow is just one leg to the stool, right? There's all kinds of other reasons to be doing this right now. And I think it's funny because I think oftentimes the conversation around multifamily real estate just gets lumped into that one very amorphous, vague bucket where it's like, matters what market you're in, matters what types of projects you do, it matters what you pay and what your acquisition strategy is. If you're buying stuff below market, it matters what you're managing. There's so many variables. So it's, it's hard to kind of have that discussion at a broad level. But yeah, it makes sense. Your comment about the market readjusting people's expectations, I think, has been interesting too, because, well, I think there's an assumption that it's harder to raise capital. And I would say it's harder to raise capital because people just haven't made a ton of money elsewhere and said, yeah, I'll throw you a chunk of it over into your deal. But like everything else isn't performing that well. So there's almost a better narrative to getting into the real estate, something that cash flows and is tangible. So anyways, that's interesting. So let's talk about why you decided to bring management in-house, because this is something that really interests me. And obviously that's what we do in our business. Maybe talk about the reasoning why you wanted to do it, why you wanted to get away from third party, and maybe some of those first steps in actually accepting that part of the process and actually taking on that workload. And then we can talk about maybe some of the challenges you've had and some of the pros to doing that.
Yeah, absolutely. So a couple steps to it, and then a few reasons. It's just some things came together that really pushed in that direction. So we use a property management company now. We actually switched property management companies almost a year ago to really just a bigger outfit, just more professional. I kind of mentioned before that handed it to a property management company that manages 1,000 units in Dayton. Well, they're only in Dayton, and we end up getting one in Cincinnati, so they weren't an option. So we used a different property management company down there. They manage like 12 to 14,000 units kind of regionally. Like they're based out of Cincinnati, Ohio, but they'll manage in Indiana, Kentucky, mostly just these 3 states right here. We call it the tri-state area. So mostly just right here, but they're big. And what they're really good at is the bigger properties. And so we had gotten a 96 unit and then a 95 unit. And I was kind of like, this is where it's at. You can have somebody on site. Let's keep doing this. Well, I still believe that, but I think, too, Axel, and I see what you buy and I'm like, man, there's a reason he's doing it. Like that stuff is competitive. I mean, when you get over 100 units, what people pay for those properties is stupid sometimes. So there's a lot of, there's opportunity in the smaller stuff. The problem is it's harder to manage. So we ended up getting, after going 12 months, we had a 48 unit come to us and the seller was interested in doing seller financing, which, again, we've kind of already hit on interest rates and you and I were talking about before. It's made it really tough. So this guy's now offering better terms. So like, that's super interesting. And then this, kind of a little 16 unit came along. Well, we took it to that property management company and, they're good people. And they were honest with me. They're like, Lee, I think we're going to be too expensive for these properties. Like they were a little bit more rural. So that's another thing, like a little bit outside of Dayton. So a little bit more costly for them to get people out there and stuff like that, right? To share their maintenance staff because they're small. So you're not putting somebody on site. But the other thing that was interesting with this one, Axel, is that the 48 unit came with a property manager that was on site. It was actually the seller's brother, which right away I'm like, that's not going to work. We're not keeping that. But honestly, the guy was doing an awesome job. We could really tell that during the inspections. We're not finding like any deferred maintenance. You can tell the residents like him. Like he's doing the unit renovations. We're looking at the unit renovations going, these are really well done. So we were like, this is going to be an asset. Well, how's the property management company going to handle that? Are they going to really allow that to work? Well, for us, we're like, well, man, if we took it in ourselves, he'd be a huge asset to us. Because like he's going to help us out so much. So it just seemed like some things were lining up. But a big part of it, Axel, was that number. Like over 100 units, everybody wants those because they are easier to manage for sure. But that's why you have to pay. I mean, I'll give you an example, Axel. I'm sure you've seen this. When we bought our 95 unit in Cincinnati, there was a 144 unit selling very close to our 95 unit. And I kid you not, just because of the unit size, just because we were under 100 units and a lot of groups won't even look at that. We bought ours for 61.5 a door, something like that, 62 a door. This other property was very similar age, needed a lot of work. It sold for like 105. So, I mean, you got to pay 40 grand more per door just for that size. I mean, I can't do it. So that's what I've seen a lot of. But again, that 144 unit is easier to manage than the 48 unit we just bought. But that's why I thought, man, if we can build this out, if we can figure this out, we've got a lot of opportunity to manage these really well. But even if our property management company didn't say, hey, we're going to be too expensive, I don't think I've seen them. We've given them some other smaller stuff. They don't manage it very well because now they're sharing staff between 2 properties and they don't do very well with that. So I knew they weren't going to do a great job because they were going to try to share staff, which we always feel like we're not getting enough of their staff. And they're going to be too expensive. So for us, we're not going to share staff. We're going to use Matt, who's on site, and we're going to, do what we have to do to help him and support him. And we're going to do it cheaper. So that's in theory. So far, it's definitely working out well. It's been, kind of overwhelming taking it in. It's a lot for us to learn, in this first one, but it really is going well. And I'm confident we're going to do a better job. And a lot of it's just, it's our baby, not our property management. Like I said, they have 12 to 14,000. We're a real small fish. But that's kind of why we did it.
No, that makes a lot of sense. I mean, it's similar to us because, in Southern New Hampshire where we do deals, we do a lot of that weird size stuff, like 10 to 50 units, right? And we got a 24 unit scattered site portfolio and then we're under contract on a 45 unit building. And then we have like a 22 unit that's like, 3 units and a 12 unit. Like we do a lot of that weird stuff. Yeah. And we can do that with third party for sure. And it's definitely something that third parties can handle. But the big thing that I think, is probably a similarity between where you're doing deals and where we're doing deals is when you start to get outside of major markets, the quality of management goes down significantly. And there's just less options available to investors that want to work with a third party management company. So we've worked with some decent ones. It's not like we've worked with we don't have like the nightmare story that maybe other investors have, but we're just like, hey, like we can just do this a little better. We can do that a little bit better. And it's a lot harder, but if you want to scale in a secondary or tertiary market in a smaller area, you kind of need that control because you don't really have that partner that can scale with you. Like if you're doing deals in a Tampa, Florida, or, like a major city where there's 10 management companies you could potentially work with, which is an interesting, challenge. But so you mentioned it's been a lot, right? It's been a lot. It's been a grind. It's probably been a lot of work. What are some of the specific things that maybe you wish you knew before you took on all of this work, looking backwards saying, wow, I actually didn't think that would be as time intensive or difficult, what have you, as I originally anticipated?
The thing that comes to mind, I think I knew it was going to be a lot. It's just, I guess I'm still searching out like some teachers on it. And like some days I want to just go to Upwork and just hire people to teach me stuff. It's just the accounting and bookkeeping is a lot. Like that's where, and I'm doing it myself because I just want to learn it. And then I'm passing it off. I'm not going to do it for long, but I really want to see it. And it's been a great learn. I mean, that's the thing that it's done for me, Axel, though. Like it's really forced me to be in the business. I mean, we are, I believe, I tell our investors this and I believe this, we are very hands-on asset managers. I mean, we are very hands-on with our third-party property management company, but we're not this hands-on. We're not as hands-on as I am right now, putting in all the bills myself and, making sure all the rent's coming in and stuff like that. And so it's been so great to learn. I mean, if I had to do this for the rest of my career, I'd go find something else to do. I'd get out of real estate. I'm not going to do it, but man, it's just a lot. Like there's so much that goes into it. And I want to do it really well. I mean, I'm a numbers guy and I want to make sure our numbers are really good. And frankly, that's one thing that was surprising to me, Axel. Again, we're working with a very good property management company in this area. Like I go to meetups and stuff. I talk to a lot of people and they're the ones that get recommended. And I agree, like they're very good. Their bookkeeping and accounting, like it's not flawless by any means. I mean, there's a lot of months where we're like, and I've got my sister-in-law works with me and we'll be like, this doesn't make sense. And we'll go to them and it's like, oh yeah, we did make a mistake there. And so it's not easy for anybody. And that's always like, that's a weird feeling that you guys had to do a $30,000 credit over here. Cause like, that just makes us feel a little weird. So it's not easy for anybody. So that's been the biggest challenge, man, is the numbers, the bookkeeping. But I really want to get that down right and then be able to train someone to really do it right. So I'm glad I'm in it. Hopefully I learn it quickly and then I can teach somebody else quickly and move on from it. But man, it's a lot.
Yeah. It's funny you mentioned that because I mean, that was the biggest thing for us too, when we took it under our umbrella. Right. And I have a partner that runs the day-to-day of our management company, but I've heard him complain a couple of times, just, humorous complaints. He's like, dude, I'm just an accountant. Like, I'm not even a property manager.
Oh my goodness.
And I was like, yeah, it's just, and it's so challenging because we also do some third-party management as well. Just, we wanted to add units to our portfolio so we could afford to hire the leasing agents, the maintenance techs, the whatever. And, he's like, yeah, man, I just spend most of my time like reconciling books, inputting transactions, making sure everything looks good. Cause it's like, you just literally can't afford to screw that up, or you have a screaming client on the other end of the phone. And people's taxes get screwed up and everyone gets really mad. So that's just what it is. And it's like, we work with an excellent third-party PM down in Florida for the deals we do down in Central Florida. And they have great accounting. They do a really good job, but still, it's like, and the big thing too is it's funny. I'm laughing now too because people's eyes are probably starting to gloss over that are listening to this. Like, really, we're talking about accounting, but but when you get into like capex and itemizing capex, and we did, this was kitchen capex, this was flooring, this was paint, instead of just lumping it all into one broad bucket, like all of that stuff really matters, and it's really important part of the process. So you can see where your money's going, right? You could track your budget versus what you project, all of that stuff. So. I identify with that, to make a long story short. And if I want to give an actionable tip to the listeners, I'll jump in and actually give the people something to take away with here. If you're working with a third-party PM or you're about to work with a third-party PM, ask for a sample copy of their owner reports so that you can look at how they structure their accounting so that you have a sense, because oftentimes, we've onboarded with PMs in other markets where we do deals. We get that first owner statement and we're like, what's going on here, guys? Like, what are we doing? So anyways, an interesting topic. But I guess how are you balancing, getting the PM company off the ground, getting your arms around that, starting to feel comfortable with that, and the other needs of the business, whether it's finding deals or continuing to, build the investor base, continuing to host the podcast, all of that stuff. Like, is that stuff kind of taking a back seat right now? Will you get it off the ground? You can kind of revisit it later, or do you have some other systems or processes in place?
Yeah, the short answer is yes, it is taking a back seat.
Yeah.
I still have time to talk with the investors and do stuff like that. I don't put that much time into my podcast. So able to do those things. But yeah, as far as like being hot and heavy in acquisitions, we're not. Maybe I'm just hoping it's like this, but I feel like this isn't a great time to purchase. I'm really feeling like this fall and winter could be a really good time to purchase. I think that's when we're going to see some better deals. I'm hopeful of that anyway. So my kind of plan, if everything just works out, perfectly, is that we get this property management thing figured out in time to see some really good deals this winter and into next year. So yeah, I've kind of just pushed that to the back and said, all right, let's take a step back. You talked about that earlier, Axel. I'm like, let's get the business ready to really charge forward. And maybe we'll time that right. And this winter we'll start seeing some distress and some good opportunities.
Yeah, no, I completely agree. And, and that's something that we're doing in our business too. Last topic on operations, and then I'll get away from this one, but you mentioned that, previously when you're working with third-party PMs, you described, yourself as a very hands-on owner, hands-on asset manager. When you say hands-on from an asset management standpoint, what does that mean? What are you doing to be really hands-on in terms of working with a PM and making sure that they're doing their job, holding them accountable, et cetera?
Yeah, I think the most important thing, and we didn't always do this, but we do a weekly call. I think it's important to have a weekly call to hear about what's going on, make some kind of come out with some action items, email those to them. And then this is what should be going on this week. And then there's usually some follow-up emails throughout the week. We always like to do ours on Tuesday. We give them Monday to kind of get caught up, do the call on Tuesday. But then, the rest of the week, hey, did this get done? We talked about doing this. Does this get done? So it gives us some things to track. Maybe a follow-up call on Friday to say, hey, what happened? Then we're doing it again next week. Like, hey, we talked about this last week. Why, is this still an issue? Why not? So I think the weekly call is the most important thing. I mean, when you get the reports, the owner reports that you talked about, Axel, really looking at them, digging in. Yeah. And each month, if you're digging in, you probably should have a question or two. There's going to be something like, why was this higher than it's been in the past 6 months? Why was this expense higher? Right? Why was our trash bill so high? What else did we do? Did it have to come out again or something? That kind of thing. So I think that's important to comb through the monthly owners report. And then, we're local. So we're on site and we usually learn a lot when we go on site. So we're not there weekly by any means. There's properties that we don't even go to monthly, but we're there every couple months at least. And a lot of them that, especially when it's the heavy value, we are there monthly and sometimes weekly when there's a lot going on, because we end up doing some of the GC work as far as, some of the CapEx stuff. So we're on site a lot and seeing what's going on and seeing that there's trash all over the place. We want to know that. And do we have a trash problem? Because it's kind of a frequent thing. So it's those three things, being close, being on site, but the weekly call is the big one. And then really combing through the monthly owners report. For sure.
That's great. As you've grown your business, right? You went from flip, duplex, 16, 10, 8, kind of small, mid-sized multifamily, spent a year stabilizing them, started doing some bigger deals. Now you're into some, again, more mid-sized deals. Yep. What do you think has been something that's changed, whether it's mentally or how you approach the business as you've stepped up in the size of the deals that you pursue, whether it's how you underwrite deals, whether it's things you care about now that you maybe didn't care about before, what have you? Do you have something that's kind of shifted in how you approach the business as you've leveled up from a deal size standpoint and in terms of, working with investors and doing just larger transactions?
Yeah, I'd say the biggest thing that comes to mind, Axel, that I'm really been working on, I'm going to continue working on, is I'm really trying to shift my mindset to being a CEO of a business instead of being an investor or just a solopreneur. Because, for the longest time, and I still struggle with it, in my mind, I'm really just thinking about finding a deal and then finding the investors and putting a deal together. And then we're going to have to manage it on the back end. Right. And that's, I don't think that's the way you really grow a business. It's the way you grow a portfolio, and that can be good. But what you end up doing is you do a bunch of it yourself. And maybe you bring on another partner and that partner does a bunch of it themselves, but you're really not building out processes and procedures and adding pieces and scaling a business. So I'm really trying to shift my focus, the who, not how type books, stuff like that. And thinking about how do I add pieces? How do I bring people in? How do I teach people this and hand off this so that I'm really the CEO of this business and not the acquisitions guy and the relationship guy and, the asset manager and this, and really just the guy that kind of does everything that's needed to put a deal together. And I knew this back then. So when I had a small portfolio, Axel, I knew then when I had the 16, 8, and a 10, I was like, man, I can keep doing it like this and just grow a portfolio and be a solopreneur and do really well. Yeah. Or I can build a big business. And I really knew I wanted to build a big business and be the CEO of a business, but I really haven't shifted into that role yet. And so I'm really trying to do that. And the route I've gone is going to allow me that, but it's up to me to make that happen and make that transition.
Yeah, for sure. It's interesting. You have to make that conscious decision, right? I don't think people have that clarity, because some people say, I want to run a big business, but all of your actions don't align with that. You don't outsource anything. You don't hire anybody. You don't give up control of anything. And you're not going to get there. I mean, and I had the same exact conversation with myself one day where I was like, do I want to be a guy that owns a lot of real estate? And that's great. And you can lead to an unbelievable lifestyle, and you can, there's nothing wrong with that at all.
Yep.
Or do I want to own a business that happens to be in the business of transacting, on real estate, raising capital, adding value, selling, turning over capital, hiring individuals? And those are two very different lives to lead, right? One of them, you're a deal guy, deal junkie. And the other one, you are a manager of people in a business. So those are two very different lives to live, right? So I think, it's good that it's good that you actually had that conversation with yourself, because most people, they don't know which lane they're trying to go down, and they make some decisions that support one goal, some decisions that support the other goal. They don't really know what they're doing. But yeah, I mean, the fact that you've taken management in-house and you're really starting to own a lot of the process is like, that's how you get going down that road for sure. That's great. So. Well, this has been great, man. I want to get you out of here on time, but why don't you tell the listeners where they can reach out to you, where they can learn more about you and learn more about your business?
Yeah, sure. Just jump on our website, threefoldrei.com. That's spelled out THREEFOLD, and then REI as in real estate investing.com. We got a bunch of stuff there, so just check us out there. I'm pretty active on LinkedIn. I'm on Facebook too, but if you look up Lee Yoder on LinkedIn, you'll find me there. But I jump on the website.
Cool. I'm sure they can find the podcast on the website as well.
Yep. Yeah.
Awesome. Love it. Well, this has been great, man. Thanks again for joining us.
Yeah. Thanks, Axel.
Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review, as it helps the show get noticed by more folks. Catch you next week.